Ever tried to buy or sell a crypto? Perhaps you were eager to jump into the market, or maybe you were looking to exit a position quickly. Whatever the reason, the experience can vary wildly. One moment, you might feel like you're navigating a seamless, efficient system. The next, you could be stuck in a frustrating bottleneck. Sometimes you find it instant and easy, a breeze to execute your trades at the price you want. The order goes through without a hitch, and you're left feeling satisfied with the speed and efficiency. This is the ideal scenario, the kind of experience we all hope for when participating in the crypto markets. But other times, it's slow and costly. You might encounter delays, slippage, or even the inability to execute your trade at all. The frustration mounts as you watch the market move against you, and the fees eat into your potential profits. What causes these contrasting experiences? That's all about liquidity, the unsung hero, the often overlooked factor that dictates the ease and efficiency of your crypto transactions. It's the depth of the order books, the volume of trades, and the overall health of the market. Liquidity is the invisible force that determines how smoothly you can trade. It's the lubricant that keeps the gears of the crypto market turning, ensuring that buyers and sellers can connect quickly and efficiently. Without it, the market grinds to a halt, and trading becomes a painful, expensive process. Ultimately, liquidity impacts whether you can actually cash out your gains. It's the difference between realizing your profits and being stuck with illiquid assets. Understanding liquidity is crucial for navigating the crypto market successfully and maximizing your returns. Let's delve into the technical definition of liquidity, a crucial concept for traders and analysts alike. Liquidity, in essence, refers to the depth of a market's order book. Think of the order book as a ledger, meticulously recording all buy and sell orders for a particular asset at various price points. A deep order book signifies a market brimming with liquidity. Liquidity essentially defines how much you can buy or sell a particular asset without significantly moving the price. It's a measure of how easily an asset can be converted into cash without causing a substantial change in its market value. High liquidity is desirable because it allows traders to execute large orders quickly and efficiently. In liquid markets like Bitcoin, which benefit from substantial trading volume and a large number of participants, the order books are typically quite deep. This depth provides a buffer against price fluctuations. Consequently, even big trades barely budge the price. The market absorbs the order with minimal disruption, maintaining relative stability. This is a hallmark of a healthy liquid market. Conversely, in illiquid ones, often seen with smaller altcoins or assets with limited trading activity, the order books are thin and sparse. In such environments, even small trades cause wild swings, leading to increased volatility and potential slippage, where the execution price deviates significantly from the intended price. This highlights the importance of assessing liquidity before engaging in any trading activity. When we talk about liquidity in the world of cryptocurrency, it's a crucial concept to grasp, especially for new investors. It's one of those terms that gets thrown around a lot, but what does it actually mean in practice? Well, simply put, think of liquidity as how quickly and easily you can turn your crypto holdings into cold, hard cash. It's about the ease of converting your digital assets back into traditional currency without significantly impacting the market price. Imagine you need to access your funds urgently. Liquidity determines how smoothly you can do that, and, crucially, at a fair price. Liquidity ensures that when you sell, you're not forced to accept a drastically lower price than the current market value. A highly liquid market means there are plenty of buyers ready and willing to purchase your crypto assets at a price close to what you expect. To illustrate this, let's use an analogy. Bitcoin, being the most well-known and widely traded cryptocurrency, is like a $100 bill. Easy to spend anywhere. Because of its high liquidity, you can quickly exchange Bitcoin for goods, services, or other currencies with minimal hassle. There's always a demand for it, making transactions seamless and efficient. Now let's compare that to a less established cryptocurrency. A tiny altcoin, with a smaller market capitalization and trading volume, is like a rare comic book. Valuable perhaps, but hard to sell fast. Finding a buyer who appreciates its value and is willing to pay a fair price can take time and effort. The market for rare comic books is much smaller and less liquid than the market for cash. This means you might have to lower your asking price significantly in order to attract a buyer and sell your altcoin without taking a loss. Understanding liquidity is key to making informed investment decisions in the crypto space. Economists see liquidity as a sign of market health. High liquidity means tight bid-ask spreads and lots of trading. making prices fair and stable. Low liquidity means wide spreads, low volume, and a market that's easy to manipulate. Picture a crypto market as a swimming pool. Bitcoin is an Olympic pool, big trades make tiny ripples. A small altcoin is a kiddie pool. One big splash and the water goes everywhere. For traders, liquidity is your exit plan. If you can't sell when you need to, profits are just numbers on a screen. Always check trading volume and order book depth before you buy. Liquidity is your insurance policy. Liquidity is what separates smart investors from gamblers. Before you trade, ask, can I sell quickly at a fair price? Make liquidity analysis a habit and you'll avoid costly mistakes in the crypto Wild West.